You ready? You got me running, you got me running, got me running. Shake it, shake it, shake it, baby. Raise your hands up, raise them up.
All right. Hi, everyone, and happy Monday as well. This is the Currency Call presented by Forex Trading Asia, and a big welcome as well and hello to all the LCMS Trader Club members as well that are joining the call live too. Hope everyone had a good weekend, and I hope everyone had a good session on Friday night as well. There was quite a bit of activity in the chat, and it looked like everyone was being sensible as well, which was good because we will go through the NFP result later with Gimme as well. But just to start off, a quick introduction as well. It is the 6th of December already, and it's episode 434 of the Currency Call. And if it is your first time here and you're watching this on the delayed feed of YouTube, make sure you do join the LCMS Traders Club. We're doing 30-day free trial, no obligation. Make sure you visit the Jindao Tai website within the video at the bottom of the video. So this currency call is run every Monday to Friday at 11 a.m. GMT +8, and the currencies we analyze are as follows. Aussie and Kiwi for Mondays today. Tuesday, we have the Euro, Pound for Wednesday. We have Yen and Gold on Thursday, and then CAD and Crypto on Friday. And this currency call aims to offer insights into market economic activities and updates, key support and resistance levels of the currencies in focus of the day, trade ideas, and of course, much more, including fundamental breakdown of big news events and what it means as well for the Forex markets. Now, this currency call also aims to be very beneficial to both the long-term investors and the short-term traders. And here we will go through what could move prices, possible trade ideas, and we'll also be highlighting potential targets and risks. Finally, and very important to take note of, is a disclaimer, and that any information shared during this session is not intended to be a trade recommendation. It is solely the opinion and views of the speaker. So please remember to do your own analysis prior to entering in any trades. Now, we did have the NFP last week, Friday night, and it was true to form as well. And just to go into a bit more detail about what happened and what it actually means, we've got Gim Hong here, currency strategist at LCMS Traders. So over to you now, Gimme.
Alrighty. A brand new week and a brand new episode with construction and drilling works with Gimme. Okay. All right. Anyway, bad jokes and all these sarcasms aside. All right. Sometimes we really need to have all these things here to, just to cheer us up a bit. Especially after having this supposedly poor NFP report. Okay. So what do I mean by supposedly poor NFP report? Okay. So looking at the results, all right, the first figure that probably like 90% of us will go straight to first is the non-farm payrolls, okay? 210,000 jobs were being added for the month of November, okay, as opposed to the forecast of 550,000, okay? And for the month of October, there was actually a 546,000 jobs being added, okay? So first impression, very bad, okay? It's just a clear disappointment, all right? Because, the US is opening up from the variant, the Delta variant issue and things like that, with the easing of restrictions going on in the US. They are more and more confident with taming the virus. We are expecting to see good figures, but then suddenly, we get 210,000 jobs being added. Okay, by the way, if you guys can't hear me because of the drilling and things like that, I'll try to speak up, all right? If you guys still can't hear me clearly or you guys need any more clarifications, okay, just feel free to put in the chat, asking me to repeat whatever I've said and things like that, okay? Otherwise, if you guys, we can always take it to the EcoFin chat and I'll just explain, again, just for you guys, all right? So 210 is quite a disappointment, all right? Now, if we were to actually look deeper into the report, things are not that bad as it seems, all right? First of all, you know what? Let's just go into the report, all right? Now, this that you're looking at right now is the I would say super lengthy, but quite lengthy kind of a report, okay, jobs report. So yes, the first line over here, total non-farm payroll employment rose by 210,000 in November, okay? But remember, okay, for the past few months of this whole non-farm coverage, I've been saying that, I've been highlighting that there has been upwards revision to the previous month's data, okay? So as usual, okay, we can expect some revision coming in for the past 2 months, all right? Over here, it says the change in total non-farm payroll employment for September was revised up by 67,000, okay, from 312,000 to 379,000. And the change for October was revised up by 15,000, okay, from 531,000 to 546,000. So all in all, okay, for the month of September and October, we actually see an 82,000 upwards revision. Okay, this is actually good, right? Remember, for the past few months, I think there are a couple of months whereby we were a little bit meh, you know, on the data, like 300 plus thousand is okay, not that bad, but could have been better and things like that, right? And then I actually mentioned that it's not the end of the story, because, you know, for the next month or two, we may actually be seeing further upwards revision. And true enough, we actually get, you know, upwards revision. So 210,000 for the month of November. Should we really conclude that it's bad? Personally, I wouldn't say it is, okay? Because, well, we can wait for December and we may see an upwards revision. Not that it will happen, okay? But it may happen, right? So, you know, it's not the end of the story yet, okay? So that's for the number of jobs being added, all right? Not bad, I would say not bad, okay? Sector-wise, okay, let me just go straight to the different sectors. Okay, where is it? Leisure. Aha, okay. This is the one. Nope. Let me just. Okay, basically what I'm trying to tell you guys is that for the past few months, okay, we have been seeing a strong increase in jobs, mainly driven by the leisure and hospitality sector, okay? Now, this column over here, okay, the most right-hand side column is for November, and then the one before it is October, and then September. Now, look at the figures, okay? November shows a 23,000 jobs being added for this sector, okay? It's actually a strong slowdown, okay, as compared to October, which is 170,000. And for September, which is 108,000. So we are actually seeing a stagnation, I would say. I mean, it may be the start of a stagnation, okay, of the leisure and hospitality sector, all right? I mean, we have been seeing like hundreds of thousands of jobs being added in this sector alone, okay? Hence, we are seeing decently good non-farm reports, okay? But right now, we are seeing only a 23,000 jobs being added. That may very well be a stagnation, okay? Now, that's one thing, all right? So figures-wise, all in all, okay, it's quite, I would say it's not that bad, not that disappointing as the first impression, okay? The first impression, 210, because we have this expectation that it's going to be good all the way, okay? But it's not likely going to be the case, like, right? I mean, like for prices, there tends to be retracements. For data like these, we can expect similar retracements as well, okay? It can be due to data tabulation error, or it can be due to any, any mistakes going on, which is why we need to wait for further revisions to finally conclude that, for that specific month, how many jobs has been added. All right. Now, that is the first piece of data. The second piece of data that we will go into, okay, is the unemployment rate. Now, unemployment rate, there's a strong decline, all right? Previously, back in October, it was 4.6%. And then, they actually expect November to be like 4.5%, a slight decline. But what we are getting for the month of November is actually a 4.2% decline in unemployment rate, which is a very good decline, okay? Very good decline, which is very strong, all right? And as of November, okay, this piece of data is actually the lowest ever since the pandemic, ever since COVID-19 was declared a global pandemic back in March 2020. Okay, so since March 2020 until now, 4.2%, okay, is the lowest unemployment rate so far. Okay, but the thing is, the pre-pandemic unemployment rate is actually somewhere around 3.7%. Okay, so good thing is we are moving closer and closer towards the pre-pandemic level. Okay, we are just like 0.5% away. So if the data were to go on, if progress in the jobs market were to go on, all right, we may actually be seeing unemployment rate going back to pre-pandemic level in maybe like a couple of months time. Okay, 2 or 3 months time. Okay, so see, not that bad, right? I mean, for unemployment rates. Okay, so that's the second piece of data. All right, now okay, for what it's worth, the current number of unemployed persons, okay, so what I've just mentioned is the unemployment rate, okay, but the current number of unemployed persons in absolute figure is 6.9 million, okay. Pre-pandemic level, okay, was around 5.3 million. So once again, we are just like some 1.2 million away from pre-pandemic level. Okay, so percentage-wise, absolute value-wise, we are seeing a strong improvement. Okay, in terms of unemployment. All right. So overall, unemployment quite good, I would say. Okay. The third piece of data that we will go into, okay, is the participation rate. Previous month, okay, for October, participation rate was 61.6%. Right now, we are seeing actually an increase in 61 up to 61.8%, okay, which is actually good, right? Remember, the participation rate, okay, labor participation rate actually took a strong hit when the whole pandemic actually hits America, okay, hits the United States of America, all right? And ever since then, I don't know, some people would prefer to not work because maybe they have enough savings to live by and things like that. And some people, they actually choose to retire. And some people, unfortunately, are having problems going back into the workforce because they are, not able to get jobs or things like that, or because they have to take care of their kids at home. Hence, they are not able to commit. Okay, hence they are not able to go to office. So with all these things coming into play, we have been seeing a very, I would say, stagnated participation rate. Okay, unfortunately, participation rate is still not at its pre-pandemic level. Okay, and if we are seeing a stagnation, okay, which I think is around like no more than 61.7 for the past few months. Okay, it's like it ranges from like 61.4 or something like that to 61.7. Okay, so the jobs market, people just have to return to the workforce in order for the participation rate to increase. Okay, but nonetheless, in November, we are seeing a good progress. Okay, we are seeing a good progress. 61.8% is the highest during ever since the pandemic, ever since COVID-19 has been declared a pandemic since last March 2020. Okay, so another, I would say, good piece of data coming in from the jobs report. Okay, and the final piece of data that we usually pay attention to is the average hourly earnings month on month. Okay, nothing much can be said about this piece of data, but yes, 0.3% increase in average hourly earnings as opposed to October's 0.4 may seem like a slight decline. Okay, it is a slight decline, no doubt. I have to admit it. All right, but remember, average hourly earnings always fluctuates, and as people actually, I would say, as different sectors, okay, of the labor force start getting in more and more workers, getting more and more laborers, okay, we may actually be seeing a fluctuation of average hourly earnings. Okay, now suppose during the pandemic, okay, I would say, okay, no discrimination over here, right? Just as a disclaimer, no discrimination over here. Okay, suppose due to the pandemic, the lower income personnel, okay, the lower income jobs have to be put to a pause, okay, put to stop for the time being because of safety issues. Okay, then the average hourly earnings will be computed, okay, will be calculated based on the higher earnings paychecks. Okay, let's put it this way: the higher earnings paychecks. And if, let's say, okay, one day, when this whole pandemic is resolved, or we start having a more stable situation in terms of COVID, okay, and when this group of lower income earners comes back in, all right, then we will be seeing a different weightage, okay, because previously without this group of people, more weightage may be placed on the higher income earners, okay, because simply speaking, we just don't have the data, okay, coming from the lower income earners. But with them coming in, okay, that may actually cause a fluctuation in the average hourly earnings, okay. Nonetheless, okay, 0.3, 0.4, 0.5, 0.6, or even 0.2, okay, percent a month, average hourly earnings, okay, month on month, is something that we have been seeing for the past probably like 12 months or so. Okay, this is like the common figures, okay, which is why I'm saying that this 0.3 figure is not that much of an issue. Okay, so it won't really cause much of a concern and things like that. It would change as people come back into the workforce or people start living again. Okay, so all in all, these 4 pieces of data, I mean, you have been hearing me saying good and saying bad and things like that. So I would say it's a rather mixed report, okay? Hence, last Friday, when some of us in the EcoFin platform, we were actually discussing while we were actually waiting for the data to be released, and some of them actually made money before the report has been released and things like that, okay? So, if you guys were actually trading, or at least looking at the charts last Friday, you will see that price goes up and down. Specifically, you see US dollar strengthening, weakening, and things like that before the US opening at 2230 GMT plus 8, after the US opening and things like that. Okay, so there's a little bit of a uncertainty, but it's a little bit of a mixed report out there. Okay, analysts out there, they have been like, they all have their own views. Some would condemn this report as 210 is going to have a negative impact on how the Federal Reserve is going to adjust the tapering pace, okay, in December or maybe in January 2022. All right. Whereas some of them, they feel that this is unlikely going to have a negative impact on what the FOMC is going to decide during their next meeting. Okay. But nonetheless, I will, give you guys an update again, or rather, I'll give you guys a prep again when when it draws near, probably like next week during just 1 or 2 days before the meeting. Okay, so yeah, all in all, okay, we are seeing a mixed report. All right, there's one chart that I would like to share with you guys. Yeah, you guys probably seen it many times already, but I just want to show you guys how far away is the US jobs market from the pre-pandemic level. Okay, at the moment, after the I've already made adjustments to the September and October figure, okay, over here, and added in the November's figure of 210. At the moment, okay, we are 4.009 million away from the pre-pandemic level. Okay, so what that means is that if the US jobs market were to gain back 4.009 million jobs in the following few months, okay, then they will be back to the pre-pandemic level. Okay, why is this important? Okay, because remember that one of the Federal Reserve's mandate, which is maximum employment, okay, will likely be met only when the US jobs market has recovered to its pre-pandemic level. Okay, unemployment rate is closed. Okay, it's like some 0.5% away. Not so much for the number of jobs added. Okay, not so much for the workforce. Okay, but with this kind of data, okay, with this sort of data going on, like 400, 300, 500,000 jobs being added on a monthly basis, soon, probably like around 5 months down the road, 5 to 6 months down the road, we will likely be seeing, this figure bounce back up to pre-pandemic level. Okay, and only when the figure actually bounce back to pre-pandemic level, then we may stand a chance. Then the jobs market will stand a chance for a maximum employment status. Okay, so which is why we have been hearing from the not that direct from the Fed, okay, but the Fed has been dropping hints here and there that, you know, the whole interpretation is that the Federal Reserve may actually be increasing interest rates starting from mid-2022, okay, because like some 6 months down the road, it's going to be like mid-2022 already, all right? And right now, many of the committee members from the central bank are actually, you know, hoping that this whole QE tapering pace can be hastened, okay? It can be more speedy. It can speed up a bit, a bit more than the decided $15 billion per month, okay? So, yeah, with this whole non-farm payroll report going down, how is it going to impact US dollar, okay? Personally, if you ask me, it's likely still going to have not the report, okay? US dollar is likely still going to be weak and strong. What do you mean by weak and strong? Okay, weak in terms of the Omicron variant, okay? Why strong? Fortunately or unfortunately, the US dollar is a safe haven currency, okay? And when it comes to, you know, uncertainty, you know, when we have like Omicron variant and things like that, you know, more uncertainty caused by this whole COVID variant, we see more, flow into the safe haven assets, you know, like bonds and gold and not cryptocurrency, okay, like the US dollar, Swiss francs, Japanese yen, and things like that. So US dollar, short run, you know, it may strengthen, it may weaken, depending on how Omicron variant unfolds, okay. Now that the music has stopped, okay, for the non-farm report, okay, it's all back to the Omicron variant, okay. It's the main limelight right now. Okay, it has been the limelight since the March 2020, yeah, March 2020. Okay, and from time to time, you have good monetary policy announcements coming in from different central banks that, you know, that throw prices a bit off and things like that. But it's all short term. You know, right now, main focus Omicron variant. All right. So, any questions on this whole mixed report?
I don't think so, man. It's all chatter about your happily drilling away.
Oh, okay. I think I'm gonna make an episode on the whole drilling and things like that, but nah, it's okay. Okay, so now let's move on to the next item. RBA, the first, the first central bank meeting for the month. Well, most of the months, I would say, yeah. RBA is always the first. Okay. So before I actually go over to the what to expect and, you know, what did they do previously, okay, just pay attention to this speech by Governor Low, okay, recent trends in inflation. I'll be sharing the link later, all right. It was on 16th of November, okay, and the main focus is just, you know, you can just go straight to, wait, let me just zoom out to get, yes, monetary policy, all right. If you guys are interested to read this, give it a shot. Otherwise, go straight to monetary policy. Which is the part that I should be focusing on. Where is it? But our central scenario. Let me just do a quick search. But our central scenario, great. So, you know, recently there's been a lot of like speculations, okay, that the RBA may actually be increasing interest rate next year, like 2022. But I shouldn't be sounding so surprised because they have actually been giving a lot of hints that, you know, this whole wage inflation target may actually be hit before mid-2022, okay? And like the RBA has always emphasized from time to time, we will only be considering a rate hike only when inflation lies between our 2 to 3% inflation targets, okay? That is the prerequisite, I would say, okay, for the RBA to hike rates, all right? Then, okay, great, I have this highlighted. Over here, they say, I quote, but our central scenario, okay, our central scenario as in, you know, for inflation outlook, okay? Over here, it says that inflation outlook is more uncertain than it has been for some time, but our central scenario is that underlying inflation reaches the middle of the targets by the end of 2023, okay? But during the previous monetary policy, okay, during the meeting, in the the statement, they dropped YCC, okay, because they deem that it's going to be no longer going to have much impact and things like that. And with the recent rise in wage inflation, okay, it's a piece of economic data that's been released on I think either a monthly or a quarterly basis. I got to check it out, okay. But we are seeing those data being strong, okay, which is why analysts on Wall Street are actually expecting this whole forecast, okay, interest rate hike forecast by the central bank to be carried earlier, okay, despite this whole central scenario to be end by 2023, okay. And where is it again? And look, it's going to be a big deal. If this comes to pass, it will be the first time in nearly 7 years that we will be at the midpoint. Okay, what this means is that for the past 7 years, inflation in Australia, okay, hasn't come close to the midpoint, okay, of the target. The target is 2 to 3%, midpoint being the 2.5% mark, okay, the 2.5% level. It has been like, 7 years since they have last come to this point, okay? So if this point were to come to, were to be hit, this midpoint were to be hit, approached, okay, by, in the upcoming data, quarterly or monthly, then we will actually be seeing a good chance that the RBA will be hiking interest rate, okay? Good chance. Why? Because they say it does not warrant an increase in the cash rate. You see the dilemma over there. But okay, this is the best we can get right now. All right. With strong employment and strong inflation, that is when we actually, that's when the interest rate actually stands a chance to be hiked by the Reserve Bank of Australia. Okay. Nonetheless, all right, it's still going to be a bit conservative. Okay, it is still plausible that the first increase in the cash rate will not be before 2024. Okay, but looking at how the RBA has been doing things, Governor Low is a smart guy. He's a smart governor. He sends out all these supposedly dovish messages, but it's still very important to pay attention to the data, because he can actually make a tweak in his tone from hawkish to dovish, vice versa, okay, from time to time, just like what we see from the QE tapering, the most recent one, I think back in August or September or something like that. All right. So yeah, the RBA, from what I know, they always have like 3 or 4 tons of options to choose from, okay, to pick. So if they were to pick the one that is more dovish, then it is what it is, okay. If they pick anything that's hawkish, then that's good, okay. So another thing to highlight in this speech, okay, is where is it? Okay, they actually admit that, it is possible that the global inflation shock is more persistent, and that the rebalancing of consumption patterns does not result in an easing of inflation pressures. Hint, inflation may be more persistent, okay? Something that we have already been seeing, okay? Look at the US Federal Reserve, Jerome Powell, he has already, decided to retire that word transitory, okay, in terms of describing how inflation behaves for the past few months and up to now, right? So the RBA is likely going to follow suit in this case, okay? Let me see, where's the other... Over here, it is therefore possible that faster than expected progress continues to be made towards achieving the inflation target. You see over here, previously he was pretty, in the previous paragraph, he was pretty dovish, okay? Now over here, he kind of dropped a bit of hint that yes, although we are expecting inflation not to be hit before 2024, but it is still possible that a faster than expected progress will be made towards achieving inflation target, okay? Hence, we can actually expect something before 2024, all right? If so, there would be a case to lift the cash rate before 2024. See what I mean? Hawkish and dovish and hawkish and dovish, okay? So what's most important here is the data, okay? The data. What data? Inflation, wage price, inflation, and employment data, okay? That would be the most important thing, because that's what determine the actions of the central bank, of the Reserve Bank of Australia, okay? It is also possible, you see, another option, another scenario, all right? It is also possible that progress will be slower than expected, which will result in the cash rate staying at current levels for longer, okay? Current levels for longer period of time, all right? So what is it going to be? I mean, is it going to be longer than 2024? Is it going to be earlier than 2024? And then here he concluded by saying the latest data and forecasts do not warrant an increase in cash rate 2022. Okay, yes, despite analysts, speculating, that's why speculating, right? That an interest rate is going to take place in mid 2022. But over here, he just says that it's not going to happen. Okay, but nonetheless, the most important thing is the data. All right, so moving on to tomorrow's meeting, okay. Like I've mentioned previously, they dropped the YCC because they've deemed it not effective anymore, okay, in terms of providing monetary stimulus, okay, which is a good thing, okay, which is a hawkish move, okay. You got to get rid of all these tools, and then you will stand a chance to increase interest rates, okay, just like QE. So what to expect this time around? All right. Expect no change in monetary policy, okay? Interest rate will likely remain unchanged at 0.1%, okay? Well, I mean, based on what I've just read out, tons of words over there, yeah, don't expect, you pretty much can say like 100%, no change is going to be made in terms of interest rates, okay? What about QE, okay? You guys can actually expect QE to remain unchanged, okay, at the current rate of 4 billion Australian dollars per week, okay? Like what the governor has mentioned, I think in 1 or 2 months ago, okay, the meetings 1 or 2 months ago, okay? They actually decided to taper, okay, from 5 to 4, good thing, but, okay, it was an initial hawkish move, okay, until they actually mentioned that this 4 billion per week is going to last until at least February 2022. Okay, so that means they're going to they're going to adopt the wait and see approach. Okay, we're going to cut from 5 to 4, but we're going to stay prudent. We're going to stay conservative. Okay, we're going to stay cautious and see how things unfold, how Delta variant unfolds. Hint, nobody is giving a concern about Delta variant anymore because everyone is paying attention to Omicron variant. Okay, so this is what Governor Low was actually worried about, new variants or the worsening of Delta variants or, and things like that, which will have a direct negative impact on the economy. Hence, inflation may be impacted, employment may be impacted, and so on and so forth. Okay, so no change in interest rates, no change in quantitative easing. Okay, so what? Do we just ignore it? No, we still have to pay attention to what they have to say, okay? So there won't be any press conference, okay? So we just have to pay attention to the rate statement. Now, like I've mentioned several times already, the main limelight right now is Omicron variant, okay? So we will want to pay attention to what the RBA, okay, specifically what they have in mind, okay, in terms of what's their view on this whole Omicron variant. Of course, I'm not going to, I mean, we are not supposed to expect anything like, Omicron variant is going to be more contagious or more deadly, more fatal and things like that, okay? This, just leave it to the experts, to the scientists, okay? What we want to pay attention to specifically is whether, okay, is there a chance that the February 2022 evaluation of QE may be postponed further, okay? So right now, the official statement says that this 4 billion Australian dollars per week of bond buying program will last until at least February 2022. Will they be hinting at, it may actually be extended to, for example, June 2022 or even longer, okay? Basically, will there be an extension? Okay, unlikely there's going to be a, what do you call that? There's unlikely there's going to bring back the timeline from February to January or maybe to December or something like that. Okay, it's likely going to just be extended rather than carrying forward. Okay, moreover, we are like so close to February 2022 already. Okay, so if the statement is going to say something like, with the ongoing Omicron variant, uncertainty caused by it, we may actually be seeing employment decline further due to people not willing to go back to work. Hence, inflation may actually rise further and things like that. Hence, this whole $4 billion worth of tapering a week may actually be more appropriate for a longer period of time, to be around for a longer period of time, then we may actually be seeing a weakening in the Australian dollar. Okay, remember, the longer QE were to last, the more negative it is for the currency. Okay, realize that while it's not always okay, it is the case. Okay, but whenever they cut QE, they taper QE. Okay, it may not be the case that it will strengthen the currency, because you must see if it's a dovish cut or it's just a hawkish cut. Okay, because if it's a dovish cut, like for example, they were to taper and say that we are not going to taper anymore for the next 6 months. Okay, we're going to lock in this tapering for the next 6 months. Then it may not be that good, because for the next 6 months, we are not expecting anything from the central bank, regardless of how the economy turns out to be, how the economy progress and things like that, which was what Governor Low actually announced during the 5 to 4 tapering, QE tapering a couple of months ago, okay? Which is why we see a weakening in Australian dollar right after the announcement was made, okay? So yeah, one thing to pay attention to is the central bank view on the Omicron variant and its impact on the monetary policy, specifically the February 2022 timeline. Okay, that's the only thing that I'll be paying attention to. Any other things, we will have to wait for the minutes to be released, probably like the following week or so, next week or so, a few days later. Then, I'll give you guys a more, deeper coverage if there's anything constructive coming from the minutes. All right. So any questions on this? Sorry, what's YCC? Yep, yield curve control. Any more things? The drilling has stopped. I'm glad. Music has stopped, and so has the drilling. Okay, so no questions. Sorry?
No other questions.
No other questions? All right. In case you guys can't hear me clearly and things like that, just visit the YouTube video and, hopefully you can get in. Otherwise, yeah, you guys can always, Traders Club members, if you guys are, tuning in for tonight's session, I'll be there. So anything I can further clarify in there. Otherwise, I can do it over the EcoFin platform. All right. So with that, nothing else. Okay, I'll hand it back to Scott then.
All right, thanks for that, Gimme, as well. And all right, guys, let's just get into it now. US dollar index. So not a lot left to go over with NFP, obviously, from Friday night as well. But just noticing we are seeing a little bit of an uptick here on the US dollar index. We're over 96.20 now, just currently trading at 96.26 is the 4-hour time frame on the SAM Trade platform here now. So interesting, obviously, going into tonight's US session. So today really is quite flat. Things have not really been moving at all. And obviously, there was a little bit of a move higher on the Aussie and the Kiwi that's going to be discussed soon with Jen. But we really did see markets sort of flood to a risk-off sentiment, which just means that anything a little higher risk, such as, a lot of tech stocks, a lot of stocks in the US, such as, Square and PayPal and buy now, pay later stocks were sold off a lot. So it's going to be an interesting one today. There's not a lot you can gain from the Aussie equity market as well, really. So just be a little bit mindful of that. It might be a session where you just sort of take the afternoon off, and then we've got the evening call a little bit later tonight at 8 p.m. GMT +8. Something I do just want to share, though, is what I've got is a comparison between the 2-year bond yield and the 10-year bond yield. So why I discuss this is, so we've got, and we'll bring that up. So this is the 2-year bond yield. So this has been steadily going up now. This is a 6-month chart now on the yield. And what this implies is that traders really do see an increase coming in quicker than expected. Now, when exactly this happens is a very good question, but Gim did point that out with the full employment. So we are close to that as well. And I've shared a similar chart in the morning market update where we still have, some jobs to recoup before we get to pre-COVID levels, but definitely this suggests that markets, especially bond traders, are definitely factoring in that it's going to happen sooner rather than later. Because if we go to we'll go now to, I'll just get this out of the way. We've got the 10-year. So the 10-year, and I'll just bring that up now. And this is, a point of interest. That's actually been going down. So what that means is that the longer term outlook is for interest rates to be quite settled and not, too elevated. So it just means that we probably will very likely see some more uncertainty in the markets in the short term. So be cautious when you're trying to buy the dip in either currency pairs or even crypto, which we've seen have been sold off extensively. So something to really pay attention to. There's not a lot of news out today either on the US side, but we do have a little bit to talk about with the Aussie and the Kiwi. And Jin will go through that now as well. But make sure you watch the replay, guys, to catch the information that was shared with Gimme as well, because it was quite a lot. Thanks again, Gimme. And over to you now, Jin.
It is finally my turn. I had a coffee, I had 2 coffees, and it's finally my turn. So what else can I add to everything that Kim Hong has said? Probably nothing much. But let's go through the news leading up for this week. Here, looking at the forextradingasia.com economic calendar. Today being Monday, we can see that there's not a lot of news to be released, especially in focus of the Aussie or the Kiwi dollar. No news today that could push prices across the board in any direction. At this point, I would say take today as a bit of a breather resulting from last week's non-farm payroll. I think that what we might see today is a bit of a bounce, a bit of a retracement before a resumption of trend, because no news and we might see some profit taking happening today. Following on from that, on Tuesday, tomorrow, as Kim Ho has gone into detail and in-depth detail, we do have the interest rate decision looking to stay, or most likely almost certain to stay at a 0.1%. Pay attention to the rate statement for the Aussie dollar from the RBA. I think that the rate statement will probably, despite all the expectation, have no change, no real surprises there. Maybe even be a little bit cautious talking about the Omicron situation. So I think that rate statement here will not have major surprises. If anything, just a hint of caution. Following from that, on Tuesday, we do have the Eurozone GDP year-on-year and quarter-on-quarter number to be released. Again, not a big change expected there. And following on from that, Wednesday, again, not a lot of news. We do have the Bank of Canada's rate decision, rate statement, and press conference. So pay attention to that on Wednesday night. We do have our live trading session leading up from this event. So we will get you prepared for this on Wednesday night during the live trading session for all club members. And then on Thursday, again, no big news to be released, but we do have some Chinese CPI numbers to be released, looking to go year-on-year CPI number from a 1.5 to a 2.5%. Why we pay some attention to the Chinese data is because it does have some influence on the Aussie dollar. At this point, I think that this might bring some upside to the Aussie dollar. And then on Friday, this is where it all happens. Pound GDP number year-on-year looking like a big change from a 6.6 to a 22.2. I'll tell you more about that on Wednesday where we look at the pound dollar. But the main focus on Friday night, 9:30 GMT +8, is the US CPI number month on month, looking to go from a 0.9 to a 0.7, a slight drop on a month-on-month number, but core CPI year-on-year going from a 4.6 to a 4.9%. As we've seen across all major economies, we've seen the CPI number exceed the central bank's target of a 2 to 3%. We've seen it all reach that 4-point-something%. And if we do see it hit that 4.9, I think maybe my guess would be a 4.8. So a 4.8 to a 4.9%, we're likely to see that dollar strength come back into play more significantly on Friday night. So what this all could mean, looking at the charts here, the Aussie dollar on the H4 time frame, what I'm anticipating is over today and possibly into tomorrow is that retracement for the Aussie dollar. It's hit this 0.7 level, which if I go to the weekly time frame is a multi-year low. The last time we came to this point and bounced off was back in October 2020 last year. The last time we broke from this point was in 2019, in May 2019, where it broke below, traded in that range and broke significantly below in 2020. So what's likely to happen here, I think we're likely to see back to the H4 time frame, the Aussie dollar bounce off this support level. I'm not sure whether it will hit all the way back towards 7120. That's a 90 pip move towards the upside. I think what's likely to happen is for the Aussie dollar to bounce a bit gradually towards that upside. We might see a 50 pip move. I don't think it will be a good trading opportunity towards that 50 pips. What I'll be looking for is to see how it reacts as it climbs back up. If it's going to bounce off 7120, or if it's going to sit across, bounce up slightly and then break 70. I would like to see it break 70 and possibly head towards that downside. So I would say ignore any moves towards the upside, wait for it, stay away, let it move up, let it move across. Only when it breaks 0.7, look to sell. So about 6983, you could have a 40 pip stop loss for a good 100 and almost 150 pip take profit level, almost a 1:4 risk reward ratio towards the downside for the Aussie dollar on the H4 time frame. This move could happen, it's likely to happen, but as it drops, we could see a lot of volatility as it hits a multi-year low. I think that beyond 6830 is a bit unlikely. I think what we'll see is a big bounce off from this support level. So watch closely. I'm anticipating a small bounce or a consolidation before that break of 70 towards that 6833 support level. With that said about the Aussie dollar, looking at the Kiwi dollar, this is a little bit more likely to happen. What I would think is that we're going to see that bounce back up to test 6819. We see a lack of New Zealand dollar news. We see some positivity from the Reserve Bank of New Zealand. So I think we might see that bounce back up. Same thing about a 40-50 pip move towards 6819, but with that dollar strength anticipated towards the end of the week, what I'm looking for is for that selling opportunity. As it rejects 6819, you could be looking again at a 40 pip stop loss from 6797, 40 pip stop loss for 120 pip take profit level, about a 1:3 risk reward ratio towards the downside on the New Zealand dollar H4 time frame. So quite a few trades setting up for this week. Not a lot of news to push prices in a crazy fashion. I think we're going to see some retracement before a resumption of trend. That was just the Aussie dollar and the Kiwi dollar that we've looked at. I think that we see a lot more opportunities on the euro and also the pound and possibly into the yen pairs as well. So stay tuned, check back over the next couple of days and we'll go through those pairs. With that said, I'll pass it back to you, Scott.
All right, thanks for that, Jin. And I just shared those trade ideas as well, everyone, in the Aussie and Kiwi discussion thread. Make sure, if you haven't already, you get into the LCMS Traders Club. A lot of very helpful insights, guys. Thank you so much for watching, and we hope to see everyone tomorrow for the Euro analysis, and have a great rest of your day. Thanks for watching, everyone. Bye for now.